Okay, this video will go through some exercises from Chapter 4 in cost accounting. So we have a tool and die that produces metal fittings to various manufacturing firms. And the following is their forecasted income statement for the next quarter. And they expect to sell 45,000 units. So we've got their price per unit, the cost per unit, and then the totals. Their fixed costs included in the income statement are $292,500 for depreciation on their plant machinery and miscellaneous factory operations, and then $94,500 for administrative costs. They've received a request for 10,000 fittings to be produced in the next quarter from Endicott Manufacturing. Endicott has never purchased from them, although they've been a local company for many years. Endicott has offered to pay $20 per unit, and RTD can easily produce the 10,000 units within its existing capacity. So again, that's always key. So they got the capacity to do it. The production of the 10,000 units will incur all variable costs, but no additional fixed cost or no administrative costs. So then would the impact accepting the special orders have on their profit? So they're only being able to sell them for $20. So let's see if as we come down and look at what they're going to do at their 45,000 units, these would be our standard prices. So again, they're going to be $200,000 more because again, 10,000 units at the $20 a unit gives us that extra 200,000 because this is in thousands. Now their variable costs will also go up, so not at that same level. So the variable cost that they give us up there is the $20, but I think that that is including the 292,000 of the factory overhead. Let me go down here. Yeah, so if we look down at their explanation, so the variable costs for per fitting, you have to subtract out that factory depreciation. Sorry, I called it overhead. But that 292,000 that they told us was depreciation, because taking this special order isn't going to increase that. So as you go down there, they take their total, subtract out that depreciation, divide it by the 45,000 units, and you get $13.50 a unit. So that is where then that difference of the 135. So the $13.50 times the 10,000 units. So then they would end up making an additional $65,000 on the deal. So then in that case, they should accept that offer because they're making more money. So that's really, I feel like the only thing that's kind of confusing in there is that they give you that cost per unit, but you just have to remember that as you read down in there, that includes that depreciation, and that depreciation isn't a variable cost. It's not going to increase. So I guess just read those ones carefully. Okay, then we have a target pricing. So we have Whitmore Glass makes a variety of drinking glasses and mugs. The companies have discovered that the market for 16-ounce mugs with college logos it's research that they're gonna sell well, and they are market priced at $26. But Whitmore will only introduce the product if they can have an operating profit of 30% of their costs. So then what is the highest acceptable price of those mugs? So then it's going to be, if they want a 30%, where does that? Oh yeah. So if they want that operating profit of 30% of their costs, then that would be 130% of their cost. So then if we take the price would be 130% of the cost. So if we take that price and we divide it by 1.3, that is what we get, the $20. So that would be the highest acceptable cost that they could have and still make their 30% profit. So it's fairly easy one. Okay, then make or buy. So we've got the audio. Quorum Audio makes wireless headphones. Each pair of headphones comes with a travel case. And then Quorum has manufactured its own since its start. Now, recently, there's a local outfitter that manufactures and sells backpacks, tent cases, and so on. And they've contacted Quorum and they said that they could produce the headphone travel cases. So based on management's experience, Quorum's cost per travel case is as follows based on their 40,000 units. So we've got our direct materials, direct labor, variable overhead, and then fixed overhead. HTG has offered to sell the case to them for $39. The total order would amount to 40,000 travel cases per year, and Quorum's management decides that they will make the switch to the HTG cases if Quorum can save at least $12,000 per year. Accepting the offer would eliminate the annual fixed overhead of the $76,000, because that's what you got to get into that, because when you're looking at the variable cost, you think, okay, well, we could add those up and compare them. What about that fixed overhead, though? Does that stay? So let's see if we take the... So if we take the 40,000 and we multiply it by the $4.70, that gives us 188,000 of overhead. But so they're going to eliminate 76,000 of that if they switch to these cases. So they want us to go through and calculate out the status quo. So if we prepared, or if they prepared the 40,000 units, so 40,000 times that $10 gives us the 400,000. 40,000 times $21.20 gives us the 848,000 in labor. 40,000 times $6.40 gives us the 256,000. And then, like I just calculated, the 40,000 times the 470 gives us 188. So if we buy them from the other supplier, it's going to be the $39 times the 40,000, which is the 1,560,000. But again, we'd have no materials, no labor, no variable overhead, and then our fixed overhead would decrease by 76,000. So then we add those all up, our total costs are $20,000 lower. So then we should buy them because we end up saving money. Now we're going to consider dropping a product line. So we have this Kitchen and Bath makes products for the home. They sell them to major retailers and do-it-yourselfers. One product that has had varying success is the ceiling fan for the kitchen. The fan comes in these 3 different sizes, and as we look down at them, we see that the 36-inch fan appears to be losing money. The other 2 are making good money. So if we drop it, the revenue would be lost and the related variable cost would be saved, but not all of the fixed cost is going to be gone. So all that's reduced is 25% of the fixed cost. So then they'd like us to prepare that differential. So again, the status quo is going to be all of these added together. So that's what they'd have. So they're making $105,720. So again, add all 3 of those profits and you'd see that. if we drop the 36, then just add the 44 and the 54-inch for the revenues, add those for the variable costs, but then the fixed costs, the 487,500 is just going to be reduced by 25%. So that all of that is not going to be gone. So if we multiply that 487,500 by 75%, that's where that 365,625 comes in. So then our operating profit would actually be less if we drop the fan, the 36-inch fan. So even though it's not doing good, it is covering part of these fixed expenses that are not going to go away even if we get rid of it. So then we would not want to drop it. We would want to keep it. And then our last one deals with the theory of constraints. So we make two different types of baseball hats. They both use the same machine, and there's only a specific capacity of machine minutes per quarter of $29,400. The fixed manufacturing costs are $350,000. So suppose that the maximum units sales can achieve is 6,000 units of each product. How many units should they make in a quarter? So we want to go down and look at our unit contribution margin of each one, and then how much, let's see if they do that for us down here below. Yeah, okay. So here's our unit contribution margin per machine. So the sport, we got our price minus our variable cost. We're making $120 per unit. For the collegiate, we're making $238 per unit. But then we want to look at it based on the machine hour minutes. So it takes 6 minutes to make the sport and 14 minutes to make the collegiate. So then what are we making per minute? How much money are we making per minute? So if we take that 120, divide that by 6, we're making $20 per minute. If we take the 238 and divide it by 14, we're making $17 per minute. So then we would want to focus more on the sport than we would on the collegiate. So we could produce 4,900 units. Oh, because if we go up, what's our total maximum? Yeah, so the 29,400 is the maximum machine hour minutes. So then if we take that maximum and we divide it by the 6 units, so 29,400, sorry, divide that by the 6 minutes, that gives us the 4,900. And then we shouldn't make any of the collegiate because we're going to make more money making that sport. Then B says now, suppose that the maximum units are only 4,200, how many should we make? So then obviously we can only do the 4,200, so we're going to cap off the sport at that one. Then those remaining minutes, those remaining would be left to make the collegiate. So there would be 4,200 machine minutes left. Divide that by the 14 minutes per unit, and we could make 300 of those. Because again, we have the, so 4,200 units times the 6 minutes, we're using up 25,200, and then we have a max of 29,400. So that's where that $4,200 minute difference comes in. So just calculate how the max you can make of that one, and then leave the remainder, and then divide that by the 14 minutes. So the goal again is to just make the highest dollar you can out of whatever that constrained item is.